Hey, welcome back to Two Stupid Guys Trade Stocks. I'm Dylan.
Nobody?
And there is a bunch of articles going around. You just type it in Google on if the stock market is actually worth it for the next decade over other investment vehicles. Because apparently, most economists are saying that the next 10 years of returns for the SPY and the Qs are going to be diminished compared to the last 10. All right. So we need your help. We need everyone to vote at the end of what option is the best. And one, I do love doing these because the last video I already said is it going to be a hard or soft landing. Hard one by a landslide. Thank you for the comments. We're going to take a look.
Dylan likes it hard.
I don't know if anyone can hear that.
Yes, I can.
So we're going to look at two quick things because this is essentially what the logic is based off the muted returns. So the SPY right now and the Qs are valued quite high. All right. Obviously, we just hit all-time highs this week again, but there's two things that can keep that going, and that is higher PE multiples of all companies overall, which can then lift the market, or corporate sales growth. So we're going to look at this, okay? So this is how long can it keep going. This is the S&P 500's operating profit margin over trailing 4 quarters going back to 2000. Long time.
I had no idea that the average company has become double the operating margin in terms of profitability over the last 20 some odd years. That's crazy.
Yeah. Yeah. The problem is, can they double it again? So that's the point of this, right? It's like, oof, I don't know if we can keep up with this scary pace, right? So there's that, obviously. Now, for the next, was it 3 quarters? The report's analyst consensus for the S&P's 500's operating profit margin over the next 3 quarters is 12.2, 12.6, and 12.5, meaning we're going to stay above that 12%, okay? Which is yay for people if it actually works. I don't know if it's going to work, but here's a crazy stat. If the latest quarter's profit margin were the same as it was 30 years ago, the SPY would be at 2,400. So less than half.
Wow. That's impressive. Like the companies are just that much more efficient now at bringing profits to the bottom dollar, or that much more greedy, depends on which perspective you want to take. But sure.
So hold on to that greedy comment because that's going to make sense here. Much of the increase over the decade has come from at the expense of labor, whose share of gross domestic income has fallen over the past 30 years from 43 to 46. We're going to show that graph here. That one's pretty interesting. So this is the long-suffering workers, employee compensation share of gross domestic U.S. income. Same timeline.
Okay. I mean, when I look at the scale on the side, it's actually not as egregious.
It looks 46 to 42.
Yeah. I mean, don't be wrong. That's still a significant headwind
10%.
as a worker you don't want to be facing. But
yeah, it is 10%. It's not great. You know, 46, 47, 42. Here's not good. So, like I said, you have expanding PE multiples, corporate sales growth. Neither provides much hope for a strong bull market over the next decade. The U.S. market's PE ratio, based on the next 12 months' earnings, is already higher than 95% of all monthly readings since 2000. So not only do we have to hope that we have record PEs going forward, it has to get even higher and even more ridiculous to have this last decade of returns. Do you have your thing up?
Yeah. So I actually have a chart up here. This is historical S&P 500 PE ratios, and this is where we're hanging out right now. This is a backwards looking chart. It sounds like that indicator you're talking about is a forward looking PE, but still like very, very elevated, levels obviously coming into this. We've only been higher than this a couple times in history, which is pretty crazy to think about where we are in the economic cycle and how high and expensive everything is.
So this is a pretty cool chart. Okay, so the red is the Qs, the blue is the SPY. I want you to look at, so this is inflation adjusted. That's super important because if you don't look at that, if you look at it yourself, you're going to see the numbers are very, very different. This is going from 10 years, technically 10 years and 4 months. and it also dividends reinvested, which is more important for the SPY. The Q has a
Hmm.
very, very low dividend. All right. So the SPY's overall return with inflation adjusted is 325%.
Okay.
The SPY is 158. Okay.
Okay.
Now, this changes when you go to a longer time frame. They're almost identical. 203.1% and 203%. This is going back to 2000. Now,
Wow.
the reason why it took a dip is because when this chart starts is at the top of a bubble. So it loses
Uh-huh.
a hefty percentage. But just to show you, 20 years, 200%, and then you get 10 years, 350% from the Qs.
Perfect.
Not super sustainable. Okay. And people think, hey, these big tech companies, they're always going to be ridiculously profitable, right? They're absolutely incredible in terms of growth. Here's probably the best example of money not making anything for you, which could happen going forward. This is Apple, about 2012 to 2016, about 4 years in this graph. If you
Okay.
had invested around there, and I cut it off, but it had gone in waves a little bit before that, you would have a 0% return.
Yeah.
4 years.
Gotta catch the right time. I bought my Apple shares in like December of 2017,
Okay, yeah, there's a little dip actually. So yeah, good call.
and I just sold most of them.
There you go.
Put it all into money market account.
There you go. See, making moves. So
Yeah.
the deal here is what's going to be the best option. This is where I need your guys' help. Is it stock market, SPY Qs, don't touch now? We're gonna cheat a little bit. You're not allowed to pick specific stocks
Okay.
because it's more for the everyday investor. Like if I am gonna start putting my money in something, I say that, and then I have Chinese growth stocks as an option.
Yes.
I just realized that.
All of them.
So time in the market meaning just hold the money in the SPYs and Qs. Change your holdings to exposure to large cap dividends because flat growth like Coca-Cola still yields money. They have a fat dividend, right? There's a bunch of these. There's a bunch of
Yeah.
stocks
Yeah.
with a decent dividend. Real estate, which is is very area dependent, and if people are into this, I have my own chart that I'm doing myself. The problem is it's area specific. I was looking at the SPY's return versus various REITs,
Okay.
and also just straight up buying houses in the area, right? So mine is Phoenix, but wouldn't buy a house in San Francisco with the returns. It's if people are interested, REITs could be an entirely different thing where you just send it and leave it, and then
Yeah.
China growth stocks because obviously they're unbelievably cheap. See one of our 900 videos on Vinny's
Alibaba
discounted
or
cash
JD.
flow,
Yeah.
Alibaba. What would you pick out of these four? You can pick
So,
two.
out of those four,
Two.
mm, uh, time in the market and Chinese growth stocks. Those
No
are the two.
change to dividends.
I am not interested in dividends.
Real
Dividend
estate.
companies are fine, but time in the market includes dividends. If you think about it, SP 100 has a dividend yield.
That's fair. Can I ask you this? Is where you live have anything to do with the real estate option?
No, it's sure that maybe that's part of it. I mean, I live in the Northeast, which is a very expensive area for housing. It's just not an area of my competence, and would rather focus on something that I at least have some basic level of knowledge in, rather than trying to invest in real estate. And in additional, the capital up front is very intensive. There's a lot to physical ownership of real estate that I'm not particularly interested in.
That's fair. That's fair. So I have two. My first house has by far beat the market. It's not even close. Second house has not. So it's
Yeah.
hit or miss. All right, guys.
All
Let us
right.
know what the decision is. I'm very interested to see because I kind of want to look at REITs going forward if anyone has any
Nice.
interest in that. All right.
All right. Catch you next one.